We're here at the Money Summit, and I'm here with Warren from Stanlib, who just finished a really interesting discussion regarding how to structure your portfolio when, well, the world goes nuts. So, Warren, I want to ask you two very specific questions here today. And during your discussion, you touched on the fact that, at Stanlib and I assume at many other asset management firms, you guys make use of certain AI tools. And my question is more surrounding the fact of what do you believe is the future of involvement of specific AI tools in fund management? And how is that going to structure potential future portfolios? And will there truly be a massive diversification between various firms, or is it going to end up that, everyone's going to start making the same decisions based on what the AI is saying?
That's a great question. And I think the reality is it's at the very early stages. Certainly what we're seeing in different industries and what we think is going to happen in the financial services industry is that the winner is going to be the mixture of the technology and the human intervention. We don't think you want to rely on a black box, which could be coming out of these AI tools. And that's kind of where we are today. Where this is going to go from here is much trickier to answer. But I can certainly say the benefits that we're seeing of using AI tools, how it's increasing our efficiency, how it's enabling us to look at much more data than we could historically, look at much more relationships than we could have tested historically, and that's clearly going to help with the decision making. What we don't want to do is delegate the kind of decision making to the AI. Because the danger with that is you don't know why it's making the decisions. The scariest conversations I've seen in the AI industry are when guys building their models say on camera that they're so amazed because they don't know what's happening, why the AI model is doing what it's doing. That frightens me. So we're building our own LLM model, for example. We know exactly how we're building it, what we're putting into it, and we can see the output is coming from what we're putting into it and trying to get out of it. So we still think that relationship between technology and man, what we've seen historically with new technology, is still going to be the way forward for at least the next few years. Beyond 3 to 5 year time horizon, much harder to answer, because by then we probably had AGI, which I'm sure you've heard about, and then technology could take over anything. So that's a much scarier time. And especially for me, who's got a son in matric and another one 2 years behind him, it's a bit scary to think of his future job prospects. But for now, we do honestly think that it's the best combination is the two of them. What companies can't do is let the AI try to do their work without the AI. That's probably even more dangerous than not using AI. But we think a combination of the two of them will be the best outcome for our clients, without a doubt.
So use it for the information, but still have a human making the discretionary decision.
Correct.
Absolutely fantastic. On a second note, and I think this is probably even more scary that you touched on during your presentation. I think that was probably one of the biggest things about what people don't really realize within the markets is correlation risk. And, as an investor, we were always taught to have not even correlation risk, diversification risk, sorry. And I mean, we were always taught, diversify your portfolios. And there was traditional ways of hedging your portfolio where you had X amounts in stocks, you had X amounts in something like gold or other assets or bonds even. And in today's market, we are seeing all these assets move in one direction, where index funds are at all-time highs, but gold is at all-time highs at the exact same time. So how do we diversify our portfolios in such an abnormal bull market to still hedge against risk as and when that correction comes into play?
So it's a very interesting question and goes back to what an investor is trying to achieve. So interestingly, being in South Africa, where interest rates are very high compared to global markets, what you're finding currently, interestingly, money market funds can still give you above 7%. Now, if you think inflation's at 3.5%, that's going to give you close to 4% real returns. In our highest equity multi-asset funds, and all people speak about this, they're trying to achieve CPI plus 5. So in the long run, they're only trying to get a 5% real return. And even if it's after a fee of 1%, it's 6% real return. But already in the lowest risk asset class, like money market, you can get 4% real return. So people need to think about balancing chasing the market with getting the return they need for their goal ultimately. And especially things like pensioners that don't need to be taking equity risk because they're at the later stages of their life and they're in retirement, to be taking huge amounts of equity risk when markets have done this well without the diversifiers, to your point, that we had traditionally, is very dangerous. Having said all of that, there's no doubt that in the next downward correction, because of, let's say, a US recession, things like bonds will act as a diversifier. Why? Because the money's got to go somewhere. And this is what people miss in our liquidity bucket that we talked about, our lenses. Liquidity is such an important lens because tends to be what happens. The money has to go somewhere. The money's not going to all go out of the market and sit on the sidelines. It moves between asset classes. Now, if you think what happens when the recession risk, exactly what we saw in the last couple of years, and especially in parts of 2022, when recession risk got high, people still went into US bonds. The problem you've got is in emerging markets, all assets tend to become risk assets in a US recession, and everything goes down at once, as I showed. So again, it's balancing your geographical exposure, your sectoral exposure, your thematic exposure, your currency exposure. Currencies can still behave quite differently. Do you have enough commodity exposure? Because that could do well in a correction. You could have equities correcting, but commodities do actually quite well, even though gold's done quite well. Next, it might be platinum group metals, or it might be silver, or it could be copper eventually having a bull market. So these things ebb and flow all the time, and hence why I said in there, you have to evolve with the markets. There's no silver bullet here. The world is changing dramatically every few quarters, and therefore we think those correlations may be changing much more rapidly than they did historically. So the days of correlations staying positive or negative for 5, 10, 15 years, we think that's unlikely going forward. We think the days of inflation remaining below 2% and flat for 10, 20 years is also disappeared. And these things are going to be much faster cycles, much more up and down, much more volatility in macro cycles, and therefore you need much more aggressive, active managers managing your money ultimately. We think that's the difference. And to the point you raised earlier, using the AI tools with the human intervention and the combination of the two is going to help us manage portfolios faster than we did historically. That's the idea anyway.
Absolutely fantastic. Warren, thank you so much for your time. Thank you very much. And to everyone watching this today, use the tools that are available to you, but don't stop making decisions for yourself. And again, if you are not evolving with markets, you are going to get left behind. So maybe it's time to rethink your portfolio. Until next time.